Hey, what's going on, guys? It's Mac here for another video for you guys from Cryptstar Staking. Of course, that is your #1 source of crypto DeFi news on the tube. Super excited to be back from vacation. Also, I'm just getting over an influenza cold thing, so please bear with me as my voice might crack and I might cough a bit, trying to cut it out of the video. But please just bear with me today. Yeah, I want to go ahead and inform you guys on a lot of things that crypto people don't look at. And for today's topic of discussion, we're going to be looking at the Federal Reserve chairhead Jerome Powell and looking at his remarks during last week's FOMC meeting. They went ahead and raised the federal rate about 75 basis points. And I'm going to listen to his remarks and kind of give you guys feedback as to what that means for the overall market in general. Now, as it's been proven over the past year, 2 years, 3 years, equities are closely tied to the Bitcoin price. So whatever affects equities is going to affect Bitcoin. And the biggest thing, a lot of traders kind of hide this fact, is that the Federal Reserve is the biggest influencer on whether we're in a bear market or a bull market. Now, if the Federal Reserve is printing money and lowering the interest rates, that means we're probably going to be in a bull market because there's more money, more liquidity in the system that can move around and make more money, right? But as the Federal Reserve takes out money and raises the interest rates, basically raises the bond rates, that means that more liquidity is going to be pulled out of the system and people are going to have less money to spend. And what this also does is it lowers the price of goods and services over time. And Jerome Powell is going to talk about that in the speech, so I'm not going to take his limelight. But let's go ahead and make sure we smash that like button and smash that subscribe button if you like this video. And let's go ahead and jump right into Jerome Powell's speech. Here we go.
Good afternoon.
Good afternoon.
Colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families.
Cheers. Just so you guys know, the tools he's talking about is the blunt force tools that the Federal Reserve has, and that is increasing the interest rates. That's the only tool they really have, is the blunt force they have of raising those interest rates, okay?
Businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today,
So what he's talking about here is stagflation. If the U.S. ends up going into a recession and goes into a stagflationary state, that means that basically the economic growth rate is going to slow down and the unemployment rate is going to remain low. So rather than just raising the federal rates and going into recession and then basically jobs are going to get cut, that's what's going to happen here in the next coming months. Apple, Google, they're already cutting jobs. So you're going to see a stagflationary state where there's going to be job market loss, but it's not going to recover. And what they can do by using these blunt force tools is they can basically raise the interest rates and cause the recession to happen without the stagflationary issues that come with basically inflation, an inflationary market.
FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate.
So he just basically guaranteed that this is probably not the last rate hike that they're going to be doing. So 75 basis points this time is quite possible to be another 75 basis points in the next coming meeting. And we'll take a look at those after this video.
We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing.
So the balance sheet is, that's just one thing that I don't think the Federal Reserve has been doing yet, and that has been offloading their own stocks and everything onto the market. So once they start reducing the balance sheet, there's going to be a huge sell-off as well, which actually hasn't even begun yet, and they're going to start talking about that from now. So that is one thing a lot of people were worried about, was not just the federal interest rate hikes, but also the Federal Reserve lowering their balance sheet.
Economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports.
So like I've mentioned in previous videos, also on Twitter, the housing market has just started to feel the effects of the recession. The housing market bubble has not popped yet by any means, but it is starting to have a sort of recessionary effect going on right now. And he just mentioned that right now. So it's happening.
As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employee employment rising by an average of 378,000 jobs per month over the last 3 months.
So a big thing to note here is that Jerome Powell knows he's not doing his job until the unemployment rate has gone up, because when the unemployment rate goes up, that means that the inflation is actually going down. There's a positive correlation between high unemployment and low inflation. Okay, so just so you guys know that that's kind of why he's pointing that out here.
The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level.
So what he's saying is that because we've had such great unemployment, the unemployment rate has been so low over the past couple of years, we've actually hit a peak, an all-time high. And that means that we're actually going to have some sort of dip in the employment rate. One reason it's very good, if you don't have a job right now, it's definitely a good time to try and find a job, just because if you're trying to find a job, the job markets are going to be crushed, and it's going to be much harder to find a job in the next year or so, at least in my personal opinion. And that's kind of what he's pointing at right here.
Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July,
let's take a look at the inflation rate real quick, what he's talking about here. So you can see current inflation rate is at 8.5%, okay? And this is not core inflation, this is actually the CPI. It was published last week, I believe. Oh, sorry, October, no, I think it's published last week. But you can see that it's much higher than the current interest rate. The active effective current interest rate before the meeting was 2.5%. So that would put inflation at about 6%, a 6% difference between these two numbers. So that means they still need to raise the federal interest rate by at least 600 basis points in order to equal the amount of inflation that we're having right now. And in the past, when this has happened, a lot of people talk about Paul Volcker and what he did. He actually raised the federal interest rate above what inflation was. So basically, we have to raise by 700 basis points right now in order to kind of pull a Paul Volcker. But Jerome Powell actually points that he's going to go down a different path more than likely during the current Fed's term.
total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
So basically, Jerome Powell's saying that he's worried about PCE inflation, which, to be honest, I haven't looked too much into, but I'm guessing it has to do, it's very similar to core inflation. And he's going to be looking at those numbers, would actually come out later this week, haven't actually come out yet. And I believe they don't include it was energy and food prices, which are extremely volatile. Okay.
Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
What he's talking about there is that once people get used to the fact that inflation is permanent, then companies, businesses, everyone will continually start repricing for that inflation rate, which means things are going to get expensive exponentially. You know, like some of those third world countries you hear about where their money is basically worth nothing. This is how it starts. So it's his job to make sure that that doesn't happen. And that's basically to create price stability. You don't, even if your wages are going up like crazy, it doesn't matter if the prices of goods are also going up. Okay, wage inflation is a real thing, and it's his job. And that's why, you know, America has the Federal Reserve that is really the really important job, and his job is to prevent that from happening.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%.
In the coming months, just remember he said months with the little s at the end. That's probably going to be 3, 4, 5 months. Okay, so no pivoting happening anytime soon. In 2008, 2009, during the housing market crash, it took almost exactly a year and a month, I believe it was, from the peak to the bottom. So you know how you have that market psychology where you go from hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, anger, and all this stuff. So this is actually the bottom right here. All right. So back in 2008, 2009, from right about here-ish range, it took a year and a month to get to here. So as of this current market cycle, we actually had a larger pump than 2008, 2009 percentage-wise. So it's quite possible we're going to have a larger downside as well. And it'll probably take a little bit longer than it did back then. I would say maybe a month or two longer to reach the bottom. So say a year and 3 months from last December, which would put us right about March next year, okay? And if you align that with 600 basis points raise, if they do 75 basis points raise and you look at their calendar and how many raises they're going to do, if they do 100 basis points raise coming up here in November, December, January, March, then we should be right around, I think, 400 basis points range. And hopefully we'll start seeing the effects of the Federal Reserve tightening, monetary policy tightening. And then we should hopefully be finding a market bottom. I'm hoping between January and March next year. Of course, we have to keep watching the markets to see what happens, but that seems to be the pace. Let's go ahead and watch the rest of comments from Jerome Powell.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
So what he's saying here is that at some point they're going to go from 75 basis points to 50 basis points, or to kind of freeze the basis point rate hikes, which might be happening during the election season here coming up. So it's quite possible they'll freeze the hikes, but then once they freeze it, there'll be a euphoria, people will be buying, and inflation's going to go up through the roof again. Then they're just going to have to raise rates again. So I think Jerome Powell sees the issue right here, and that's why he's just like 75, 75, 75. So we can go through the elections relatively smoothly without having a huge market crash, but it's going to be a very painful process just going down slowly over time. And if there is a big crash, then hopefully that's actually good for the bears, because then the markets will pick up and we can start going up again. But there's going to be one final crash, or we're going to be waiting in pain for 3 months as the market slowly goes down and gets eaten away by these interest rate hikes.
We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time.
Like I just said.
The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines.
So 4.1%. And I think, what did he say, 4.1?
The median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than.
So he's saying we're going to be going up by about 1.25% more is the effective rate, 4.4%. So about 1 basis point, 1.15 basis points higher. So 50 basis points rate hike and a 60 basis points rate hike coming up here probably in November, December timeframe. Okay.
In June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now.
So for me, being in the Marines, I just want to rip that Band-Aid off and be like, hey, dude, can we do like a 100 basis point rate hike right now? Get the inflation completely wiped out, destroy the markets, and then just start from the bottom and just go up from there. What do you guys think? Is this your preferred method? Do you like to kind of like have this long-term like needle sticking out of your arm or knife sticking out of your arm? Or would you just rather pull it out and just let it heal up right away? Please let me know below in the comments.
We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply.
Rapid.
Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions.
That means people getting fired. Woo, 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 woo.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. So
he has definitely stated exactly that they're going to stick it to the man, or what do you call it, stick it hard. So I would not try and fight the Fed. We are going to keep going down, and they say we're in a bear market. People's heads are going to go rolling. Unemployment's going to go up just so that we can fight inflation, which is actually a very good cause, because we don't want to end up like Chile or some other country that has like some crazy inflationary currency, especially because the rest of the world kind of relies on the dollar for stability, for price stability. So yeah. Anyways, thank you guys for viewing. That is it for today's video. I really hope you understand exactly what is going on with the Federal Reserve and how that affects Bitcoin prices in general. You guys have an awesome day, and I'll see you guys all in the next video. Peace out.